Good afternoon. Today is Friday, June 12th, and this is another episode of Wall Street X's and O's. Hard to believe we're already halfway through June. I like to kick things off by saying that all of the opinions and insights on this show are mine. All the research that we do as far as our sources will be provided, because we're really about giving credit to those whom have produced this. This is also not a solicitation to buy or sell any stock, bond, ETF, mutual fund, etc. This is merely a show to give you guys an idea of what I'm doing and why, as well as help you guys become better investors. That really is the bottom line here. So we're going to kick things off here today. It's been a crazy week. I tell you what, on top of the 3 solid months of market performance, we saw a week unlike we've had in a really long time as far as just an exhale or sell-off, which is kind of where I'm going to start here. I find it interesting, to say the least. Thought I have my page ready. See, when I say uncut, unedited, inevitably, I usually show that. But I was watching Jay Powell. He is the Fed chairman, speak this week on Wednesday, and he talked. I thought he gave a pretty good synopsis of what's going on. I like it because he really is not trying to pump things up. He's not trying to be political. In most cases, I have one complaint, which I am going to comment on. I thought he was very above board and very straightforward. He talked about how unemployment was going to be a challenge. He talked about how jobs that have been lost, many are gone. He talked about the challenges that COVID is going to continue to provide as we reopen things. So I thought he was being very honest, and I appreciate that. What I found interesting was how the markets really reacted to that. I mean, seriously, that's all it took, and the bulls weren't running for the barn. It's like they heard one crack of thunder and bam, they're out of there. I mean, it's pretty incredible. What this means to me is that, we've seen the market soar 45% since its lows over the last 3 months after a record 30+% plunge in March, depending on what part of the market. S&P 30 plus, small caps north of 40. Only to see on Thursday the markets tumble 6% in one day. I think that really, to me, what that says is the market is really structurally weak. There's not a lot of stability there for it to react that violently. Really, throwing everything. It's like that old saying, don't throw the baby out with the bathwater. That's what I really felt like the markets have been doing here lately, both on the upside and then to the downside on Thursday. It reminds me of why asset allocation is so important, and making sure that your allocation reflects either both your risk comfort as well as the current risk paradigm that the market presents. Okay, it shows me why owning bonds is a positive. It shows me why owning gold can be a positive, and act very much like a life preserver during very strong times of uncertainty. The Fed also commented on how they really see 2 more years of below target inflation. They talked about not raising rates or doing anything on the rise side through 2021. Now, cutting rates is a whole nother story, although we're at zero interest rate environment, not right now, which means we're knocking on the door of a negative interest rate environment, which if you know what that sounds familiar or sounds like, is Japan. Here's a good stat for you on Japan. The Nikkei or Nikkei, I don't speak Japan, I don't speak Japanese, my bad. And I'm looking at my graph here, in December of '89, okay, the Nikkei market peaked out at north of 38,000. You know what it closed at yesterday? Just a hair above 22,000. So you're looking at 3 decades of nothing. You got a government that's been very, very proactive. They've been buying Japanese treasuries, Japanese mortgage-backed securities, Japanese equities. They own a pretty good or sizable percentage of all of the Japanese debt and equities that exist on this planet. That is not a good thing, because the Japanese market has struggled for years. You can also look at Europe. and their zero interest rate environment hasn't been real positive there. They've had a decade of very, very low performance or underwhelming performance. And when you look at years of a zero rate interest environment or a flat yield curve, what is the impact? It's a very horrible environment for banks, insurance companies, pension funds, value stocks, which are companies that are undervalued or pay dividends. But it also has been very positive. So on the flip side of that, for gold, long-term treasuries, specifically zero coupons, which is interesting, growth stock, which is big tech, and then also has been good on the equity side from a standpoint of utilities, telecom, and REITs. So those are places to go during times like that. It's one we're going to get familiar with, people. I have a chance, because I don't think this is going to be the end of it. On to our markets. Not a whole lot of change from a standpoint. Growth still leads. Tech software ETF is plus 12.8 for the year. The NASDAQ 100 is north of 10%. If I look at the value side, if I look at momentum, if I look at low volatility, if I look at high quality, all negative. Okay, anywhere from minus 3.5 for the Fidelity Momentum Factor to minus 17% Russell 1000 value to minus 22% S&P High Dividend Low Volatility Index to the Vanguard US Quality Factor Index minus 12. Lots of pressure in the market, very narrow leadership, okay? So it doesn't give you that sense of feeling good about what's happening in the marketplace. Right now, the way I look at it, and you'll laugh at this, is money doesn't grow on trees, okay? There are no free lunches in life. If CJ and Lizanne, my kids, are listening to this, they're going to laugh and go, geez, I probably heard Dad say that 100 times. It's true, okay? The problem, and I've been pounding my fist on the table for weeks, we do not have a liquidity problem, okay? The federal government and Federal Reserve have flushed our economy with cash, both literally and figuratively, okay? The problem is this: we have a solvency issue, okay? And that is the real challenge. And once the fundamentals catch up with this and come to grips with reality, it's going to be interesting to see how the markets handle it. Because we know that it can't stay like this forever. We know it's not an if, it's a when thing, okay? Another major point that I wanted to really focus on was, and this is where I have a problem with what Jay Powell said. I think it's probably one of the few political things he said, okay, just to be critical of him. And I actually think he's done a very, very good job under a very, very tough circumstance. He says this, and I'm going to quote, he said, Jay Powell had to say about and speak about the health of the economy, and he really felt that the economy was very strong pre-pandemic. I feel that he was dead wrong. Honestly, you can go back to from 2009 through 2019, this whole recovery, which they are calling the longest, and it is bull market on record, was not a strong recovery. It was actually the slowest and lowest recovery, as well as the longest on record. You saw the Federal Reserve and the government with QE 1, 2, and 3 and other easing packages trying to stimulate the economy and keep things going. I would argue it was on life support. Okay, what I think we've learned over the last decade is that we have an economy that's totally reliant on the public sector, either in the form of repeatable fiscal stimulus or unprecedented monetary stimulus. And that's the only way we've survived. That is not an economy when things get unsettled like they are now that you make a bet on. Okay. Interesting stat from Bloomberg. Bloomberg did an analysis, and sorry, I'm rocking here. I'm a rocker. When I was a little kid, I could sit there and I would rock. It's a way, it soothes me, you know, what can I say? They did some analysis, and they said that 30% of the 20 million Americans who lost job in the last 3 months, these are people on reoccurring. Okay, so reoccurring filers, and it's actually much higher than that. I'm going to touch on that right after this point. It says they really feel that 30% of those jobs are permanently gone. Okay, that's a big number. So when you think of unemployment and how important being fully employed as an economy is, that is most likely not going to change for a while. and with the government stance on that this is going to be 2 years of dealing with this challenge, that's when I really look at things are going to be tough roads to go ahead. Okay, on to unemployment. We had a really interesting claims last week. They said we had 1.54 million people. They looked at reoccurring appliers for unemployment was at 20.93 million. This is the only positive. That was down 339 million from the previous report. The problem is we also had pandemic-related claims, which the PUA is, again, these are independent contractors and sole practitioners. Those increased last week by 706,000 for a complete total number of 11.2 since all this got started. When you look at everything as a whole, total personal claims for benefits was approximately 34.45 million. So if you factor in the number as of May 23rd, which was 20.93 million, you factor in the 2 weeks, which is how PUA is reported, plus state claims, you're looking at a number, like I said, you get to 34 million, and that's just overwhelming when you really think about it. Which, if you look at that number, it represents an implied unemployment rate of 23%, not 13.6 or 13.8 like they reported last week. Okay, that was a bad number. The markets went up huge on it. I was a little bit angry that they didn't go out and correct it because I didn't think that was right. But moving on here, talking about, again, an economy on life support here. And this goes back to pre-pandemic, okay? The whole goal of the government was a natural interest rate level of 3%. They wanted low inflation. 2.2% was the inflation number they were aiming at, and that's really what they wanted to try to do. Okay, what I see in this behavior is that I feel the markets are very prone to being very manic. Okay, in both directions. The economy is not. Okay, you've got a market that's very, very manic to the upside and the downside. We've seen that in the last 4 months. We had a sell-off in March, April, May, or huge rebounds. Okay, that's very manic. It's just not normal. It's not typical that these types of periods last, both on the downside and the upside. Okay, moving forwards here. If you go back to the financial crisis, so this is '08, and I apologize for jumping around. These are just really good statistics, okay? The Fed balance sheet pre-2009, so this was '08, was stable at 800 billion. They went up to a max of around 3.7 trillion plus or minus, okay? Right now we're at 7.2, and the government has positioned themselves to do whatever they have to do to prop this economy up and prop people up. We've had one round of stimulus checks for individuals. We've got all sorts of stuff for small businesses. Most likely we're going to see more of that, because here's why. Companies can't operate at a 50 or 70% capacity, 75% capacity. Most restaurant owners will tell you we need 75 to 80% capacity to break even. So when you look at what the parameters are in Colorado, just for example purposes, it's 50% capacity or 50 people, whichever is less. You see people sitting outside. This is not going to work. What this could lead to, if things don't really turn around, are an increased number of bankruptcies, which we're starting to see. At the big level, we're already seeing small businesses go out of business. I think there was a poll taken last week, not a poll, but an informational research report was taken, and 75% of small businesses have already said they're not reopening when they come back. I think we're also going to see a big default cycle. Okay, we've already had a period where people have been alleviated from the stress of paying mortgages, paying credit cards, paying car loans, paying other types of loans. Okay, this can't go on forever, because then we've got a financial crisis in the banks again. Okay, so that's where there's a fine tightrope that I see the government walking, and I think this is going to be a challenge. Okay, this COVID deal is not going away. It is not gone. and the possibilities of a V recovery, I think, are gone as well. I think we're going to see volatility increase, which we've seen last week. Significant increase in volatility. That is going to continue, okay? On a positive note here, David Rosenberg, he was one of the chief economists when I was at Merrill Lynch. He now runs his own research shop, and I love his stuff because he's really, really good from a factual standpoint when it gets to fundamentals. He kicked out how to invest in post-crisis homebody economy, which I love. So for those long-term investment horizons, I can tell you, here's some things to think about without a doubt that are worth looking at from a long-term standpoint based on how things are changing, and we know they're going to continue to change. 1, home office technologies. 2, video streaming. 3, online retailers and those that are entering that market or enhancing that market. Healthcare service providers, biotech and pharma, obviously, when you look at the testers. Utilities and residential REITs, that is a given. Semiconductors, delivery services, hygiene producers, duh. I mean, you're seeing people that make spirits or liquors that are now producing these sanitizers. I crack up Tanya and I all the time because we've got a couple and we spray them on, you wipe them on your hands. It smells like a shot of tequila. Not that I've ever had one, okay, but it smells like tequila. Just saying, okay? Robotic technologies for manufacturing where you have less staff, more robotics, telecommunications, treasuries, municipals with a credit quality or higher, as well as corporate bonds, gold and precious metals, food suppliers, and last but not least, consumer staples. Just to end on a positive note, I always try to execute a strategy like Peyton Manning, okay? Meaning there are ways to take opportunities in every type of market cycle, every type of environment. Sometimes we throw interceptions, okay? The key is this: as the markets have bounced back, I have moved towards pulling risk off the table because I really feel there are more challenging days coming. I'm not saying worse days, just more challenging days, which are going to create volatility, which is not an environment for the equity markets. So to combat that, you increase exposure to asset classes that tend to be opposite equities or provide a degree of opposite from a risk standpoint, low correlation, that's the word I'm looking for, to equities. So that's what we've been done. We've added a gold position, which has done real well for us. We've also added more bond holdings, but tried to be in the right places, okay? If you think about this, I'm going to close. Right now, we've got the long bond U.S. government treasuries trading at about 1.4, 1.42%. If we are on this low interest rate cycle, okay, and say they're targeting, some people are targeting the long bond at 0.5%, what that means is you are going to see an appreciation in long-term treasuries of anywhere from 25 to 30% over the next 12 to 18 months. That's if, key emphasis if here, we see rates continue to drop lower. Watch interest rates. Don't watch the stock market. The interest rate market will tell you or tip its hand as to what's really going on in the economy. If you see interest rates continuing to drop, that usually means fear is in control, money is running to safety, okay? Keep your eyes peeled on the interest rate market. With that said, guys, I told you it's been a lot of fun. I appreciate everyone for tuning in. I hope you're finding these beneficial and educational. I hope it helps add some clarity, okay? Because with clarity, when we have the facts, we can make good investment decisions. Doesn't mean they're right all the time, but they're right more of the time, and that is what my goal. So again, for Friday, June 12th, 2020, this is Craig Model Mog for this week's presentation of Wall Street X's and O's. Model Mog out.